This video is especially made for those who like to invest their portfolio by their own. Maybe you are doing yourself for and say, I don't have to pay these fees for an advisor, but I would like maybe to have a second opinion on my portfolio to see if I'm doing everything right, or maybe I should be doing something different. So we're going to show you the 5 steps that you have to take in mind for you to review your portfolio like if you were a pro. So let's get started. First step. One of the first things that you have to do is to know where you want to go. Your portfolio, it should be like a car. You have to give them the destiny. You have to know how long it's going to take you there. I mean, what kind of car are you going to use to get where you want to go? Most of the investors, what they do is they just have to like have a car that is going to run really fast, but they don't know where they're going. Like maybe you're taking a lot of risk, and maybe it's not necessary that you're taking that risk, and maybe you can use a different portfolio. But the main thing that you have to know is like for each of your financial goals, you have to have a portfolio. It's not the same if you're investing for your retirement or maybe for your college education for your kids. When you're thinking about your portfolio, what we usually see is that maybe you just have a big portfolio where you put all your investments there. But when you're thinking about your goals, maybe the way this will look like, it will be something like this. Maybe you know that there are some goals that you need. For example, someday you're going to retire, or maybe there are some things that you want, like maybe take your kids to help them with their education, or maybe for traveling each year, or maybe there is something like you wish there but you cannot have it now. But as you know, all of these goals are going to have a different set of time. I mean, it's like they're not going to happen all of them at the same time. So not all your portfolios should look the same. For example, these are all the years that you're going to be saving and maybe investing. And maybe when we talk to retirement, you can say like, okay, I'm going to be saving for all these years, and maybe for all these years I'm going to be withdrawing money. So if you see it in a way, this portfolio will start here and will last many years, because you will say, I'm going to be investing here and I want this portfolio to last all these years. As you can see here, we have like 40 years in this case. But then you're thinking about maybe your daughter's education, and you say like, it's going to happen here and I have to have that money available for just a shorter period of time. So you should not look all the portfolios in the same way. I mean, the asset allocation, the way, the ingredients that you're using for this kind of portfolio that is going to be longer instead of this one that you're going to need it before, have to be completely different. And sometimes that's one of the first, mistakes that we see with some of our clients, that they try to put everything in the same basket and it's going for different goals, and then they start to withdrawing money from a portfolio that maybe was made for a longer period of time, instead of building a special portfolio for those different goals they have. So let me show you more about what I mean that each portfolio needs to have their own speed. Like it was like a car, and you say, okay, from 0 to 100, I would like to go at 54. And what it means? Well, it means that your balance could go down in this 10%, or maybe it can go up this 16%. But you want to know this range, because you will say like, okay, if something happened in the markets, I know that if I go at this speed, I don't have to be worried if my portfolio drift down a little bit, because I know this is a normal range of your portfolio that can move up and down. The way that you build your portfolio is going to be each time you add more stocks. Oh, well, the car is going to go faster than when you add some bonds, or maybe when you add some cryptos or things like that, the car, of course, is going to move faster. But it's really important for you to know what is the normal range of your portfolio and at what speed your portfolio should be going. You don't want something like this to happen to you, that is like, okay, you start investing, or you already are investing and have everything in just one portfolio, and you want in that portfolio to help you with for your retirement, for your kids' education, and different things. And then when you have to pay for your kids' education, this portfolio can go down like 10%, But you don't need that because it's like maybe you have to pay for that kid's education for the next year or this same year, and say, I cannot have a portfolio that goes down in that percentage because then I will not be able to go and pay for those goals that I have. But instead, maybe you said, no, I can allow my portfolio to move around because this is something that I'm going to need for my retirement and not for now. Second step, you want to gather all your information in just one place because you need to see what are the ingredients that you're using in your portfolio. Sometimes I see that the most of the investors say, I like this stock, I'm going to put it in, and now I receive another information, I'm going to put this other stock here. But when we add all that information, sometimes I say, well, you have too many stocks of just one sector of the economy, and maybe you don't know, it's like, or maybe you're buying an ETF fund or an index fund, and when you're buying that one, maybe you have some risk of what we call overlapping, because it means that maybe you have, I don't know, one stock here, but in the index fund you already have that stocks also, and when you add those two positions together, maybe you're saying, I didn't want to have that percentage in that particular stock. So it's really important to gather all your information, and when you have it, is now that you can run some analysis of how is your portfolio inside, what are the ingredients that you're currently using. So when you gather all that information, what are you going to do with that? I'm just going to show you the main kind of topics that you have to see in your portfolio so you can know what kind of portfolio do you have. Sometimes when I ask my clients, well, what's the percentage that you have invested in stocks or bonds? What percentage is invested in the US stocks or stocks outside of the US? Sometimes they don't know because they are just chipping in some different stocks there. So the way it should look, you can do this in an Excel spreadsheet or whatever you want to use. So the way it should be is like you should know how much you have in cash, how much you have in stocks, bonds, or other kind of investments. And then you don't leave that information there. You go beyond that and you'll say, okay, let me see in the equity investment or stock investments that you have. You want to know, like, okay, is it everything in just stocks of big companies, or do I have also stock from mid-sized company or small-sized companies? And then you would like to say, okay, I want to have a little bit of everything maybe, or maybe just what you're looking for is that you want to have everything in large cap or small cap, and then you can say, okay, my strategy is going where I want to go. You should also do that if you have some fixed income or bond investment. You should also do that, but maybe you want to know, it's like, okay, what kind of credit quality do I have? Is it like high quality, like treasuries and things like that, or is it low quality? And also, like, okay, what's the duration? It's like when these bonds are going to expire. It's like how long they are going to be around there, because you want to know in what kind of things you are investing. For example, in this particular case, it's just for educational only purpose, and you can say, oh well, all my money is invested in low quality bonds, and they are in short duration and things like that. So, like, one of the things that you would like to do is to set a benchmark, because you don't want to be running around like crazy and saying, well, was it better to be guessing what kind of different stocks or bonds or investments I want, or maybe it was better just to invest in an index fund, and maybe it would not be so fun as you're looking for, but maybe that would be much better. You don't know, but that's why you want to have a benchmark. For example, if then you say, okay, my portfolio is invested 60% in stocks and 40% in bonds, you would like to run some numbers and to say, like, for example, this red line is going to be your portfolio, and the blue mountain there is going to say, like, well, maybe you're not doing as well as you think, or maybe you're doing better than investing in just an index fund. Also, you would like to see what kind of sectors in the economy you have, if you have all the sectors, or maybe you just say, no, I just want to invest, I don't know, in technology, and that's what I want to be in right now. Or maybe you just say, like, I just want to have stocks from North America, or maybe I want to have stocks from outside of the US. I would like to see that too. So it's really important to gather all your information so you can get something like this to know how much you have in each kind of different stocks, bonds, or maybe crypto or different kind of assets that you would like to have in your portfolio. The third step, you would like to know what are your costs. Most of our clients, maybe they say, no, my investment, I don't have any cost because I'm not paying for a financial advisor, so I'm saving that. No, everything in investment, as everything in life, has a cost. So you have to know how much are you paying for everything. For example, there are some costs of investing in mutual funds or ETFs. Some of them maybe can have a cost just for getting in, like a load cost. When you get into that, they're going to charge you something. And maybe just for them, maybe no, it's something that happens. It's like for the money they're investing for you in an ETF, in a mutual fund, they're going to be charging you some administration expenses for that. And there are some also mutual funds that if you want to get out of that, or some different kind of investments, when you want to get out of that, they're also going to charge you another expense there. So you have to know how much are they are charging you and what is normal and what is not normal. I mean, it's like if you're paying too much. Some of our clients say, no, I just buy some in stocks, so I'm not paying for any fee for mutual funds and things like that. But you also should know, like, you're buying that through a broker, and the broker is going to charge you because, like, he's going to be in the middle. Somebody wants to sell that, somebody wants to buy that, and he's going to split the difference there, and it's part of their his earning there. So it's really important to see, like, when I have like structured products and financial products, like some clients ask me, oh, this one I just have earnings, I don't have any cost. Please don't believe that. Everything has some cost. And let me show you something more about it. So it's going to be really important for you to know how much are you paying for your portfolio. You have to gather all the information. When you see the ETF funds, the mutual funds, go and look for the expense ratio. That is going to tell you how much are you paying for all the administration of that mutual fund or that ETF. And then you can add them together. It's like you say, okay, I'm paying all these fees. Please don't take this like any investment suggestion. Just your our random investment just for educational purpose only. But you want to know, like, okay, I'm paying this amount. I mean, have invested in this amount in this fund, so I'm paying this one. And you want to know how much are you paying. And then when you have that information, you will say, okay, why should I be paying like this percentage here, 1.27%, instead of maybe paying a lot less like this fund? And maybe when you see it, I don't know, they could be investing in the same thing. But what you're looking for is you don't want to pay like 1%. Just imagine for a while that you have $1 million and you're paying 1% per year. That will mean like $10,000 per year. And if you invest with that money you have in that portfolio for over 20 years, you're going to be, I mean, paying in fees over $200,000 there. That is way too much money. So always when you choose your investments, also go and check what is the expense ratio, how much I'm paying that, and always try to understand how much are you paying. And if you don't understand or you cannot guess how much are you paying, please, as we mentioned before, don't believe that the product is free. There are no free financial products in investments. Fourth step, you should have a recipe for your portfolio. As we mentioned before, it's not something that you put in there like a box that you're getting different things there. You have to have a recipe. What I mean with a recipe, when you're gonna bake a cookie or a cake, you know that you're gonna need like one cup of flour, and maybe a little spoon or salt. You want the same for your portfolio. You want to know, like, okay, I want to invest like 1 cup of stocks and a little spoon of emerging market bonds or something like that. Because what is going to happen in your portfolio is the different assets are going to start moving For example, what you don't want to happen is like some stocks goes up and other bonds goes down or whatever happens there. And when you see your portfolio, maybe you don't have that cup of flour that you're looking for, that cup of stocks, and maybe just now you have a cup of salt and a little spoon of flour there, and you don't want to have that. So what I mean is like you have to take control of how your portfolio is moving, and that's one of the hardest decisions for any investor. That it means like when you have to sell a stock or a bond or any kind of investment, if you don't have a recipe, you will have that stock like forever. But maybe when that stock or that investment is going down, you have never sold it because like you say like, oh, it was going up, up, up. So I keep it. So what do you want to do is like, for example, I want to have like something 1% of you feel like I should have this percentage in stocks, I should have this percentage in bonds, and you have to gather again all your information, use a spreadsheet, and then you said like upload all the information that you have there and say, wow, maybe your portfolio is moving. Let me show you how it looks like. Remember that we are talking that this process of investing should not be something like you're putting things there and you don't have no control of how you're investing your money. And you don't want to do that if your retirement is coming close, or maybe if you have a big amount of money there and you would like to know, for example, they say like, okay, I want to have like this percentage in stocks and maybe this percentage in bonds. And then from then you want to say, okay, from these stocks, I'm going to divide them in the following way. Like this is just for education purpose, it's not an investment advice, but you can say like, oh, okay, from this 100, I want to have 35% in the S&P 500, for example. Or you want to have a percentage in international stocks or this percentage in treasury bonds. But then what is going to happen is that maybe, I don't know, the US stocks are going to start growing. And when this number starts growing, all the other numbers are going to be smaller. And that's what you want to do. You want to that and say like, okay, now I have my 35% that I want to have in that particular group of stocks or that sector of the economy, and you say, okay, maybe this way over 40%, and you're gonna say, okay, I'm going to sell that the thing that went up to buy the things that maybe went down. And that's what you want to do in investments. Like, okay, you're selling this one to buy the ones that went down and to keep your recipe. And as we mentioned before, to keep your cup of flour and maybe your little spoon of salt. So the fifth step will be to have a lot of discipline and control over your portfolio. What I mean is like two main different aspects. The first one is like maybe you start investing in something because you believe that that something maybe could go higher, or maybe you're worried about inflation and things like that, and you start to invest in gold, or because you think that a recession is coming and you say, oh, I'm going to invest in gold, for example. I'm not suggesting that. I'm just saying like, and then maybe just you went and invested in that asset. That asset was going great, but maybe that recession didn't come. I mean, it's like, and you say, well, maybe I don't need to keep having this kind of investment. So go back to your, I mean, the hypothesis that you took and say, should I be investing in this kind of asset, or maybe the different things that I was taking into consideration are not happening anymore, and maybe I don't need this asset anymore. Or maybe you're saying like I was having some cash waiting for an opportunity to come, but that opportunity means that this and these different things should happen for me to take action. But the second main aspect that I want to tell you here is like your portfolio should also take into consideration your personal finance. What it means? Well, just for this example, let's think that you and your wife are working, or your couple are working. Both of you have great jobs, so you can have an investment in some different portfolios that maybe go faster as a car. But maybe one of you get fired and you don't have that income that is coming to your house. Well, your portfolio should change, and now you can say like, I am not able at this time in my personal life, I mean my personal finance, to be taking this amount of risk. Don't do what most of the clients, I mean the investors do, like when they see like they're not producing enough money in their work or in their jobs or in their business, they think that the portfolio is going to be the magical solution, so they start to look for different kind of risk investment that are going to supposedly provided with a lot of money in just a little time. That does not exist. If your personal risk is going higher, your portfolio risk should not be going higher. I mean the risk, because then that's not investing. That's going to a casino or speculating, and that's what you're not looking for. We hope all this information has been helpful for you. Now you know how to review your portfolio, and in case you need a second opinion, we provide hourly financial planning for our clients. We can help you with that. We can help you reviewing your portfolio or your financial goals. Thank you.